the representative thing that moves the financial market is interest rates. Financial assets move according to these interest rates. Recently, there are signs that Japan's interest rates will change. Recently, high-ranking officials from the Japanese government and the Bank of Japan have repeatedly mentioned the timing of an escape from deflation and an exit strategy. At the time, financial markets in Japan and around the world were turbulent. A major change in economic trends is being prepared by the Bank of Japan, which became the first in the world to implement quantitative easing and even experience negative base interest rates. Governor Kazueda sent a message to prepare for the market. The problem is the ramifications this movement will have. Japanese investors have continued the yen carry trade by borrowing the money at ultra-low interest rates and investing in assets that provide high profits, such as in the United States as a result of the continued money released for decades. As of the end of last year, the funds released around the world alone amounted to 531 trillion yen, which is more than twice Korea's gross domestic product. If interest rates in Japan rise, yen carry trade funds that left Japan can return to Japan. This process could shake up the global financial market. Carry trade is an investment method that borrows low interest rates currencies and invest in high interest rate currencies. A representative example is Japan's yen currency trade, which has maintained low interest rates for a long period of time since the 1990s. Hedge funds mainly borrow the yen at the interest rates close to 0% and made profits by investing in deposits in currencies that pay relatively high interest rates, or in stocks, bonds, and real estate that allows for arbitrage. For the first time on December 20th, 2022, the Bank of Japan signaled a change in monetary policy. Japan, which has maintained ultra-loose monetary policy despite the tightening trend of major central banks around the world, has revealed its intention to reduce monetary policy easing. On this day, the Bank of Japan concluded a two-day monetary policy meeting and decided to maintain short-term interest rates at minus 0.1%. The long-term 10-year interest rate target was decided to be maintained around 0%, but the allowable range was expanded from plus minus 0.25% to plus minus 0.5%, suggesting a possible change in yield curve control policy. So far, the Bank of Japan has been choosing government bonds in unlimited quantities to keep long-term interest rates down to 0.25%. The expansion of the allowable range of changes in long-term interest rates at this monetary policy meeting meant that the scale of the Bank of Japan's government bonds purchases could be somewhat reduced. The person who has urged the peaks regarding the timing of the exit strategy is Bank of Japan Governor Kazuo Ueda. In an interview with the Yomiuri newspaper on September 9th, Governor Ueda said that the negative interest rate policy will be lifted once it is determined that the 2% inflation target can be stably achieved even after the negative interest rate is lifted due to the rise in the economy and prices. Governor Ueda's remarks in the financial market that day were interpreted as meaning that the Bank of Japan may lift negative interest rates earlier than expected. The Japanese financial market is paying attention to when the Japanese government will announce an escape from deflation. The declaration of an escape from deflation is a rite of passage that acknowledges that an environment has been created in which Japan can stop 10 years of large-scale monetary easing and begin an exit strategy in earnest. The Bank of Japan virtually raised the long-term interest rates to 1% at the end of July. This was a contradictory policy of maintaining large-scale financial policies while taking a step toward an exit strategy. It was a desperate measure by the Bank of Japan, which had to support the economy while controlling prices and the low yen. Declaring an escape from deflation means that Japan, the only country in the world with a negative interest rates, will transition to a normal country. If Japan begins its exit strategy in earnest, it is highly likely that the yen carry trade, which involves borrowing yen whose interest rate is virtually zero, and investing in assets in countries with high interest rates will be rapidly liquidated. As of the end of last year, Japanese investors held overseas securities worth 531 trillion yen. Japanese investors are the largest player in the bond market of major countries such as the US, UK, Ireland, and Australia. In the International Financial Stability Report released in April, the International Monetary Fund said if the Bank of Japan adjusts monetary easing, Australia, the European Union, the United States, Indonesia, Malaysia, etc. are likely to face a capital outflow warned. The impact on Korea will also be significant if the value of the yen rises due to rising interest rates. The price competitiveness of large Japanese exporters will decline. Korean companies' global market strategies are also bound to change. The landscape of the Korean and Japanese tourism industries competing to attract foreign tourists may also change.